All right, we're ready to go. I'd like to warmly welcome our panelists. First, on my right is Jelena McWilliams. Jelena is a former chair of the FDIC, but of recent vintage, president, corporate and external affairs at Plaid. I think you're wearing.
I am wearing Plaid. I'm wearing Plaid for that. Is this working?
Let's see.
Oh, okay.
There it is. Yeah,
I'm wearing Plaid for that reason, only for that reason.
And on the Zoom tube is my good friend Randal Quarles, chairman of Cynosure Group and former vice chair for Supervision. In fact, the first vice chair for Supervision in the United States of the Federal Reserve Board. And today I'd like to talk about sort of a potpourri of issues with them. I think it's always great to have former regulators because they say stuff, you know, they're really willing to. Now these two are always willing to talk, but you know, at least they say something. You get a lot of regulators up on these things and they may draw people, but they don't say a lot, right? So hopefully we're going to have a very informed decision about where we're going with financial stability and all kinds of stuff. So let me start with Randy. Randy, the FSB chair, Andrew Bailey, asked you last year to chair the G20 strategic review of the FSB's implementation monitoring process for the post-crisis reforms. We're all pretty aware of all the reforms put in place after the 2008 crisis around the globe. Could you walk us through the goals of what you're doing, how you're doing it, and what it's going to result in? Because I think it's going to be a pretty important report. I don't know that anybody else has really done an in-depth sort of post-mortem on the crisis, the solutions, and where we are.
Thanks, Tom. Thanks for having me. It's great to be here, even virtually. Everybody can hear me, right? This is all working?
Yes.
And Randy, they can all see you on like a 30-foot screen, which I'm so glad it's you and not me.
Yeah. And Randy, you've got about probably close to 200 in the room and probably 200 online, so.
I'll watch what I say.
Please don't.
So as a lot of folks, I'm sure who are here know, the South African presidency of the G20 last year asked the FSB to conduct a review. It was essentially, it had been 15 years since the FSB had been created in 2029, so through the end of 2020, in 2009, so through the end of 2024, that was 15 years, which seemed like a good time for a stock take, particularly around how the FSB's various recommendations over those 15 years had been implemented, how they were working, where there were gaps in implementation, which really had not been done. The FSB has a sort of standing committee to review implementation, but a comprehensive, from the beginning review had not been done. So Governor Bailey asked me to, as an outside person, to chair that process. And, the idea was to begin with an historical assessment. And so the first step, which we put out at the end of last year, we called it an interim report, to review what all the recommendations had been and where there were gaps in implementation. And there were obviously there were a few places. Basel III was a place where there has been delay in implementing the last steps of Basel III. There were issues around some of the too big to fail measures, particularly cross-border resolution protocols, some severe gaps between the measures that have been taken with respect to banks versus the measures that have been taken with respect to non-banks. And that historical review was intended to set the stage then for the next steps, which would focus on lessons from that history and to make some specific recommendations about how to improve the monitoring process. Now, this next step is occurring in 2026 under the presidency of the United States. So the U.S. has the presidency of the G20 this year, and I think their thought, which is not just a U.S. thought, as we worked through this first interim report on the history and where there were gaps, there were a number of jurisdictions at the FSB who said that this should not just be a review of where there are gaps. We should delve into why there are gaps and which gaps. When I was a very young lawyer back in the Calvin Coolidge administration, I was working on a pointless project that some junior partner had decided he wanted that really didn't make any sense. And I was staying up nights, and late working to get this exactly right. And a senior associate gave me a very wise piece of advice, which is that if something's not worth doing, it's not worth doing well. And I think that is a question that came up in the first phase of this review. So here are gaps, but maybe some of these things really didn't need to be done. Right? They were recommendations that made sense at the time, but with the benefit of hindsight or the benefit of seeing how difficult the implementation was, learnings over the course of 15 years, maybe rather than simply saying there are gaps that need to be addressed, should focus on what are the core issues that remain as a result of these gaps. So I think that the next step of this review, given the U.S. presidency's focus, is going to look not only on what should the FSB doing to improve implementation broadly, but also to focus on why some of these gaps exist. And maybe part of those recommendations will be that the FSB should be focusing on some of these core issues, and that will improve implementation. Another adage I'm very fond of being, if everything's important, nothing is. And if you have created this vast panoply of regulatory framework without prioritizing what really needs to be done versus what would be nice to be done, and simply say, here's what hasn't been implemented and you need to get on it, that actually might not be the most effective recommendation for financial stability going forward.
So Randy, one other question on financial stability. Have the slopes in Salt Lake gotten any snow?
It actually wasn't that bad of a season, although I think spring is here today. It got cold enough that we could make snow. So the skiing actually most of the winter wasn't too bad. It was a little slow at the beginning.
Yeah. All right, Jelena, I want to get to Synapse in a minute because you were the Department of Justice appointed you as the trustee in bankruptcy, and Synapse is its own weird story. But before you talk a little bit about that and how people lost money and why they lost money, and it goes back to what we said before a little bit, that money's always moving. You can't always tell where it is. You want to talk a little bit about what you're doing at Plaid and your new role there?
Sure, I'm happy to. But I want to say first, before that, this is the pre-pre. This is why we always let Randal Quarles go first in a congressional hearing. And I had to teach both Joseph Otting and Rodney Hood that if any Congress member says, this is a question for all of you, do not answer. Let Randy go. Randy will start with FDR and the administrative state, and by the time he gets us even to the 1990s, we're done with the 5 minutes of the questions they can ask. So do not even ask, do not even look at the member of Congress, look at Randy. And Randy, we're very grateful to you for all of that. So sure, I recently, about 2 months ago, I joined Plaid. I realized that in my career trajectory, I haven't done two things. I haven't done a fintech job, and I haven't done a real Wall Street job. And I have many comments about the real Wall Street jobs. This fintech Plaid came along.
So this is not a fabric business?
Well, despite my blazer, right. No, it's not, even though my mom was a seamstress. So I'm president of corporate and external affairs at Plaid, and Plaid provides the infrastructure. It's one of the most trusted infrastructure for connecting banks and consumers and other financial institutions. So if you have well, I don't want to use any of the companies' names just in case they're in the audience, but if you're connecting I can just say this, if you're using TurboTax, which it's that time of the year, and you're connecting TurboTax to your banking account to extract some information, including your savings and other brokerages and other things, if you're fortunate enough to have those accounts, Plaid provides the connection. So that's like one of the most basic things. We also do a number of other things, including credit underwriting based on cash flow, fraud monitoring, very good tools for fraud monitoring, and then we also look at different ways of just kind of moving money along the ecosystem. So that's what I do. Synapse, are we talking?
Yeah, let's talk about Synapse.
Do we have to?
Yeah.
There are bad jobs in this country. And when a DOJ calls you up and says, you are a perfect person for a job that won't pay, you should probably say no. So the U.S. trustee called me up and basically said, we are looking for somebody to become the trustee in bankruptcy of Synapse. I actually had, at that point in time when they made the call, I didn't have to look up Synapse because I actually saw some of the rumblings about the end users being left without funds. But I think it was end of May of 24, that I got this call and was appointed the trustee of Synapse in bankruptcy. And at that point in time, there was about $300 million, I don't want to say missing, but it wasn't available in the Synapse ecosystem. And what Synapse was, for those of you that didn't follow it closely, a fintech that partnered up with banks and other fintechs. And so the way it worked, I don't have enough hands, so I may have to use two of yours. Ready? Okay.
Right.
All right. So there would be the end users, basically the depositors here. They would put money into a fintech. So that's my second arm. My second arm is a fintech, any fintech, for various reasons. So consumers, depositors put money into a fintech. I need your hand. Okay. That's Synapse. These fintechs would put money in Synapse in your other hand. Those are the banks in the Synapse ecosystem. So it goes consumer, fintech. No, don't make the sound effects yet. I'll tell you when. So it goes consumers, fintech, Synapse, banks. And there's put your fingers out, many banks. Okay, now we're good. You can put your hand down. So that's kind of the ecosystem of how Synapse functioned. And so what happened is that when Synapse, there were some issues with money movement, which caused Synapse to declare bankruptcy. That is still being investigated, I believe, by the authorities. All of a sudden, thousands of people were left without their money. So it was between $200 and $300 million when I was appointed the trustee. And the problematic thing was we couldn't figure out who held the money because along this chain, the money was moved. And once Synapse deposited money in the banks, if you had an account in John Smith's name, that was easy. We can return John Smith's $100. If John Smith's $100 got commingled with Jane Smith's and, Tom Vartanian's money, and now there was 300. Tom should get it, yes, just for making the sound effects.
Right.
So it just became complicated. Like if you had $300 in one of these banks, who did the $300 belong to? And so without being able to do actual forensic analysis of their records, which the records were extremely convoluted, we couldn't figure out where the money went. We were left with 4 banks in the ecosystem. And this is where I told one of the bank CEOs, one of the banks, they held $42,000 of somebody's money. And that bank, literally, I don't want to use the name, you can read this in the records, literally got dragged through 2 years of Synapse resolution, bankruptcy, and everything else for $42,000. And the CEO was like, can I just put $42,000 somewhere? I just don't want to be in the news anymore about $42,000, right? It became really convoluted to actually figure out what was going on, who held the money, the records of the banks. Some banks were more willing to work together than others. But by the time we discharged the case in bankruptcy, the CFPB got involved in a little bit of a novel authority. I reached out to all of the regulatory agencies. I didn't find much of a sympathetic ear to see if anybody would be willing to take over the Synapse records. All of a sudden, these Synapse records became a hot potato. No matter who I ask, attorney generals, heads of the consumer protection agencies in different states, do you want Synapse records? No. My people are telling me I shouldn't. I was like, I don't want them either, people. Somebody should be having these records and be able to actually work on them. The problem became that whoever held the records would have to do the analysis, right? You can't just leave these people. But it was devastating, and I think what the lessons learned there, I don't know if there are broader lessons for the ecosystem as much as Synapse was messed up. It was one of those things that, but unfortunately, we make laws and regulations based on messed up cases. In a good time, nobody says, oh, I'm going to make a law or a regulation about this. It's usually something bad happens, and then based on that bad precedent, we actually end up engaging in laws and regulations. So if you really think about it, that's how we got the agencies, OCC came in the aftermath of the Civil War and unifying the currency. The Fed came after JP Morgan bailed out the financial system of the United States, and then the FDIC came after the stock crash in 1928. 33 was the creation of the FDIC. So we get these things done. So I just want to be really careful about lessons from Synapse, because I don't think they go across they're not applicable to the entire ecosystem. I think Synapse was, in terms of the ledgering and the record keeping, an anomaly. But I think there are some things that others should be aware. If you're a bank and you're not daily reconciling what you have on your balance sheet, you probably are not doing a good job, and you could be. None of these banks wanted to be mired with the bankruptcy and the plight of the consumers. Yes, they ended up being that.
Yeah. I read your trustee report, and I would commend it to everybody here. It's one of the best mystery novels you'll read in a long time. But I read it as what you just said, a enormous treatise on how not to keep records.
It was fascinating, to be honest with you. It was fascinating. And then even as we tried to reach some of the Synapse engineers to help us, the problem was we couldn't pay anybody. There was no money in the estate. In the end, I'm no longer at Cravat, Swaine & Moore, the law firm. We did it on a pretty much pro bono basis. On a pro bono basis. We didn't call it pro bono basis, but we did it without charging anybody because there was no money. So we couldn't pay anybody to actually reconcile the records. And it became so crystal clear that, my God, if you're in the business of banking and moving money, keep records, keep good records.
Yeah, right.
Like just and try to reconcile every night. It would be very nice if you did that. Anyway, so if you really want to use any lessons from Synapses, if you have to do the hard things, do them well.
It's the same lesson that you get from FTX. If you read a lot about Sam Bankman-Fried and FTX, it was nobody's watching, I don't need records, right? Same sort of thing.
It's kind of an interesting, and we don't have enough time for this, philosophical quest. But a lot of these instances where we had a big crisis, a company that caused some kind of a financial turmoil that then percolated throughout the marketplace, there is a common thread. And a little bit of that is driven by the record keeping and how seriously they took their job maintaining the records or not.
Right. Randy, I want to switch a little bit to FDIC insurance or insurance of accounts and the Fed discount window. Last night at the speakers dinner, we had some interesting conversations about the movement of money, the enormous amount of uninsured money that moves in the system every day. Mike Hsu said, the former acting controller, said there's $7 trillion in uninsured deposits in the banking system. And, if you compare that to 1934, when the purpose of FDIC insurance was to stop runs, we really have a different set of problems now with all the money moving in the system that's uninsured and the velocity at which it can move. I mean, you can move your money on your phone instantaneously, as we saw at Silicon Valley Bank. And so the questions that I wanted to pose here is, what do you think we need to do in terms of modernizing deposit insurance, the Fed discount window? Because it seems to me like the regulatory system is a decade or two behind the technological speed and velocity at which financial services and money now move.
I think that's exactly right. I think I think that technological advances, both in communication and in bank technology, have essentially increased the liquidity need of the system to a much higher degree than we appreciated before the events of the spring of 2023 and the failure of SVB. In the aftermath of the creation of deposit insurance, the need for liquidity in the system because of the comfort of depositors that was increased as a result of deposit insurance fell to a much lower level than it had been before the creation of deposit insurance. And a consequence of that was that the Fed allowed what I think is its primary reason for existence really to atrophy. The Fed was created not to do monetary policy, really. I mean, and sometimes in my more philosophical moments, I wonder whether monetary policy even works. In ancient Egypt, the priests of Ra used to believe that the sun was being swallowed by a serpent called Apep every night. And so they went through elaborate rituals overnight to ensure that the sun would rise. And lo and behold, the sun rose the next morning, which they believed was due to their rituals. Again, in my more philosophical moments, I wonder whether we are sometimes the priests of Ra with respect to monetary policy, but where there is a clear function. And what was the original purpose of the Federal Reserve, the reason we call it the Federal Reserve as opposed to the U.S. Central Bank, is that it is intended to be a liquidity reserve for the entire system and to provide liquidity when there is a need. But because deposit insurance had so reduced the liquidity need, for decades, the Fed sort of let that become a utility that that was not particularly prominent in what it focused on and what the public thought about with respect to the Fed. With the result that when SVB was failing, it hadn't even made arrangements to borrow from the Fed. And the Fed hadn't insisted that it make arrangements in order to be able to get liquidity from the Fed, even though, again, that was what would have been called for in those circumstances. If it could have gotten liquidity, all of those securities that were on its balance sheet had really almost no credit risk. The Fed could have provided high levels of liquidity against that balance sheet. And if it could have held those securities to maturity, SVB was solvent. It was only because there was a run that was occasioned by the lack of liquidity. So I think the Fed needs to really reinvigorate its provision of liquidity. It also clearly believes that it's taking steps to try to do that. It's announced some work on the discount window. But I would be even more radical than simply reinvigorating the discount window or requiring prepositioning of collateral for discount window lending. Because I think, again, we've seen that the liquidity need has risen back to where it was before the creation of deposit insurance, at the least. And in those circumstances, the Fed should be very liberal in the provision of liquidity, and not just to the banking system. If we were creating the Fed today instead of in 1913, it wouldn't occur to anyone that it ought to be the flywheel of the banking system. It should be the flywheel and the provider of liquidity to the financial system, which is a whole broader range of entities than in 1913, obviously. And we should formalize and regularize that as opposed to putting together ad hoc facilities in the events of crises. We should be providing that liquidity more regularly as part of the regular operation of financial institutions in the system for them to meet their intraday liquidity needs, as opposed to insisting that all their intraday liquidity needs have to be met through their own HQLA. So I think there's a lot to be done there because we are back to the situation where the demand for liquidity in the system is essentially as high as it was at the time of the Fed's creation. And the purpose of the Fed at the time of its creation was to provide that liquidity.
Tom, maybe if I can just add something. What surprised me is how lagging the government's response was. And so Randy's and my successors testified before Congress. And when they were asked, so this is a matter of congressional record, when they were asked, when did you learn about liquidity issues at Silicon Valley Bank? I think Randy's successor said Thursday morning. Mine said Thursday afternoon. And that bank was taken into receivership on Friday. And so, and that testimony was one of those, that hearing was one of those moments where I was thinking, thank God it wasn't me and I didn't have to testify. And I'm sure Randy was saying, oh, I wish I was there and I had to testify. But if you think about it, it was all over Twitter, it was all over the social media, and yet the government's, the people in charge, like Thursday was when they heard about the liquidity issues, which, again, to your point about how fast money moves, I mean, that's there is a dichotomy there.
Yeah. So I would be remiss.
Tom, one thing I should add that I didn't put in my answer, though, because you asked about deposit insurance, and here Jelena and I, may not be completely aligned, which is a very rare thing to happen.
Somebody mute him.
But obviously you could address this liquidity need by significantly increasing the amount of deposit insurance, having it be unlimited so that there were no uninsured deposits, taking it up to 10 million, 50 million. There have been various proposals out there to increase the level of deposit insurance. And that would address, that would address this need in the same way as the creation of the FDIC and where the deposit insurance limits were set at the time of its creation and the nature of the deposit system at the time of its creation significantly addressed the liquidity need of the system then. But I think that the moral hazard that's created by very high levels of deposit insurance is greater than the moral hazard that is created by the sort of supervised provision of liquidity from the Federal Reserve. And so I think the better way to try to address it is by addressing the procedures of the Fed for providing liquidity as opposed to raising deposit insurance. I mean, there wouldn't be deposit insurance for the non-bank portions of the system. Even the more dramatic proposals that are out there wouldn't suggest that. And yet that's still, a very important part of where runs would occur in the current financial system. So I just think the moral hazard is less. Increasing deposit insurance from where it was last increased to makes perfect sense up to a point where you're essentially addressing the retail deposit holdings. But having it cover essentially all business deposits, raising it to tens of millions of dollars or being unlimited, again, I think the moral hazard there is too great. So the right way to address it is through the Fed's liquidity.
Yeah, I mean, it's an interesting point you make. I hope everybody is appreciating it, and that is that to some extent, I think, correct me if I'm wrong, you're saying that the Fed's lending volume is a report card on the effectiveness of FDIC insurance.
Yeah, yes, I think the two are reasonably close substitutes for each other.
Yeah. Jelena, I'd have to ask you about FDIC insurance, obviously, but I'd also want to see what your view is of the FDIC's willingness to play ball with these charters that the OCC is giving up. They've awarded 5 conditional charters to 5 crypto companies last year. There's another 18 applications in the hopper. All indications are that those approvals are going to follow. To the extent they want to take deposits, they need FDIC insurance. Is the FDIC going to cooperate, or are they going to have a different view?
Yeah, this is what's actually interesting, and maybe I can just address the increase in the deposit insurance to correct Randy's wrongful assumption. I personally don't care where that deposit insurance is, but I have never had a banker who came to me and said, I want to pay more in deposit insurance assessments. So when we're talking about increasing deposit insurance, up to $1 million, 500,000, whatever the number may be for these accounts or that, every banker that ever came to talk to me about that, and subsequently since I left the FDIC, was basically like, but somebody else should pay for it. And so, I don't mind. You want to make it $5 million, right. Go for it. And your bill is going to go 20x.
Right.
So it is one of those things that I think people need to be careful what they wish for. I've learned in the United States there's no free lunch, the hard way. As far as the approvals. So a number of these applications from the OCC are for national trust banks with non-insured deposits. And this is the moment where I think I have a FDIC alumni table here. They're all like, thank God, we are not there. We don't have to deal with this. If they're uninsured deposits, it's fine. Mm-hmm. The insured deposit ones are going to be interesting because they have to get approval from the OCC. They have to get approval from the FDIC. In some cases, they also have to get approval from the Fed. Depends on how they're structured. I think it's important to recognize that these approvals are conditional. I do think the FDIC has an interest in acting in a uniform and predictable manner. Every time a bank CEO came to me and told me you cannot approve ILCs for deposit insurance. And I said, what's interesting about the language for the ILCs in the statute? it's the same language as it is for you as the bank. So the language in the statute does not say if you're ILC, you should have these requirements. Really, and Rayanne, correct me if I'm wrong, it's the same requirement for absolutely same statutory requirements. And so it's interesting that even the banks were fighting the ILC's applications and deposit insurance approvals, even though the requirements are the same for both entities. And in fact, I think that the FDIC took an even more stringent route with the ILCs, requiring them to have higher levels of capital as a source of strength than the banks did. So I do think it's going to be interesting to monitor how these applications proceed. I think people need to be just politically astute about where we are. In the last Trump administration, there were 3 national trust banks approved with non-insured deposits, and only 1 was left standing through the conditional period and the approval, and then that one immediately got a BSA/AML consent order, which they worked through. I do think it's important to recognize that where we are in the presidential term cycle, we have about 2.5 years left. So if we have 2.5 years left and you get a 3-year conditional approval, you can do the math. You may or may not get it approved. So I do think there's a number of variable factors here, but if the application is ripe, it's complete, and it's submitted to the FDIC's board for approval, either to the board or on delegated authority. I think most of these will be taken on by the board because they're significant issues. I think the board will apply the same thinking and the reasoning. And then don't forget also that the OCC controller sits on the FDIC board. Yeah. So, that's just how the system works.
Yeah. So it's interesting you say that, because when I left the government and started practicing, one of the first things I worked on were non-bank banks, and the whole Dimension litigation went to the Supreme Court on non-bank banks. And then we handled a number of insurance companies that wanted trust banks, and then there were the ILCs. And so this non-bank urge, or this urge to be a bank if you're not a bank, has been going on now for some 40-something years. I argue that it was stimulated by the deals we did at the FSLIC when we looked for anybody to buy a failing S&L. But whatever the case, if you take the total number of applications and people who try to get into the banking business and look how many is left, it's not a great record of success. And I argue from that eventually people understand that if you are not regulated and you want to be in the regulated industry, it's a culture shock and you feel like a dog that's caught the car, right? It's not easy for everybody. I can tell you from representing a lot of clients who thought they wanted to be banks and said, well, wait a minute, I didn't want that. And so it's an interesting dichotomy that's going on now with all the fintechs and the crypto companies filing for banks. We'll see how that works out. But closely aligned to that, Randy, is the whole question of Fed access, right? And so the Fed just released the Kraken, right? Kraken last week.
The way you said that sounds like a rap song.
No, it's actually Clash of the Titans, a movie my wife and kids watch all the time. But they've released the financial Kraken, and Kraken's gotten the first Fed master account, and it's therefore it's the first digital asset company to be able to do that. And the whole question is, with what's going on in fintech and the barrage of people are moving in every direction, and I do find it interesting that an industry that started basically with great disdain for governments and regulation now wants to be a bank regulated by the government. But be that as it may, what's your take on that movement, on the Fed skinny account, whether or not we're going to see that adopted? And interestingly enough, with the Kraken situation, at least yesterday I looked for some announcement of that on the Federal Reserve Board site. It's not there. So I guess the Federal Reserve Board is taking the position that's the bank's decision out there to give them an account. But what's your take on this, and where does the system need to go in terms of modernization of these kinds of issues?
So I think consistent with what I was saying before, again, if you were creating the Fed today, it just wouldn't occur to you to say that this ought to be a system for the banks as opposed to for the financial system. This ought to be the central flywheel of the financial system. It's perfectly reasonable. The Fed has, financial stability interests and some regulatory interests in ensuring that those entities that have access to a master account at the Fed are supervised by the Fed and that they don't pose undue risk to the system. I think that the sort of three-tier taxonomy framework that was created in 2021 for allowing different types of institutions to have master accounts, where if you weren't subject to traditional bank regulation, then there would be more things you would have to agree to in order to get a master account, with tier 3 being the one that you'd have to agree to the most. I think that that was a pretty good resolution of the issue. And while I have great sympathy for the urgency and, behind the idea, Governor Waller's idea of the skinny account as a way to try to speed this up, the Fed has been so conservative in thinking about those tier 3 institutions and has really granted none of them the full access that would be required. They did for one firm that wasn't really a fintech or a payments firm. It was essentially a logistics firm. And so to try to break through that institutional conservatism, Chris has proposed the skinny accounts. But I worry that the limitations on the skinny accounts, including the limitations on the Kraken account that was awarded, really are too great for it to be that useful for the fintechs. They may create financial stability issues in the future because among the limitations are that you don't have access to the discount window. That's among the limitations for the Kraken approval, as I understand it. It's certainly among the limitations for the skinny account proposal, and and other limitations that ultimately could exacerbate a financial stability issue if the time comes when you've got stress in these institutions, which will become an increasingly important part of the financial system and the payment system as a result of having master account access, don't have access to these services from the Fed, including, most importantly, provision of liquidity, except on an ad hoc and jury-rigged basis. But I worry that if that becomes the path of least resistance, we give these skinny accounts or these limited accounts, as in the case of Kraken, then the Fed says, now we don't have to worry about the hard step of actually granting full master account access under our tier 3 framework. And that sets us up for a problem down the road. So I would, consistent with my view that the Fed ought to be much more liberal, aggressive, revolutionary in thinking through how it provides liquidity, I think it ought to be much more active in providing full tier 3 access than in trying to provide these limited accounts.
Okay, we got time for one or two questions. And as people are going up to the mic, I just want to ask you one question, Jelena, very quickly. Have we reached the point in time when fintechs and banks are at a truce, or are they still competing against each other fiercely?
Depends who you ask. I think that a lot of fintechs that have been kind of challengers to the banking activity, I don't want to say challengers to banks for the exact reasons that Randy just outlined, have matured in their execution and operations enough where banks are comfortable teaming up with them and considering them third-party service providers. So I think we're in a better place, although there are still some open banking issues. For example, come to mind the Section 1033 of Dodd-Frank, whether or not the fintechs are allowed access to the consumer's data that's permissioned by the consumer and whether the banks charge. There's still a lot of open issues, but I do think that the system has evolved, and I think banks are a lot more open to working with fintechs.
The question is along those lines. Actually, 1033, JP Morgan Chase actually wants to charge for the data for Plaid or any other data aggregators. So can you go a little bit deeper on how you're managing that balance between the consumer choice and the bank data monetization? Can you go a little bit deeper into that for just educate.
I just said we're friendly. But thank you for your question. It is a complicated issue, and frankly, the CFPB is working on a proposal that would identify whether or not there is this section 1033 of Dodd-Frank, if you haven't followed it, and basically says that the consumers have the right to their information, but it's all the good laws written. It kind of leaves a lot of things out in the open. And they are at the agency's interpretation, and the CFPB is supposed to be writing the rules on this. And so initially, CFPB came out in 2024, I believe it was 24, and said, banks can't charge for access to this data. Basically, any one of you will permission your bank to share information. I gave the example of TurboTax. With TurboTax, Plaid will go in, extract the information, and give it to, and TurboTax will get the information, and so you can do your taxes. And for that, Plaid shouldn't be charged. That's what the CFPB said. Bank lobby sued the CFPB. The cases are still ongoing. One of the cases was lost in court. CFPB lost. And so then CFPB started reworking the rule. And so now it's still in the process. It needs to be reproposed. I'm hoping the reproposal comes any moment now. But the issue really is how much. There are three major issues. One of the major issues is whether or not banks are allowed to charge providers like Plaid for access to this information. And wherever the CFPB ends up, and of course I have a vested interest that they end up in saying, you shouldn't charge. Here's the bottom line, and I think people just need to be aware of this. Again, no free lunches in America. I've learned the hard way. If you end up allowing banks to charge for this access, Plaid can only absorb, and companies like Plaid, only so much of that cost. Essentially, that cost will be passed on to customers of Plaid, in this case, TurboTax and others, and effectively, those costs will have to be passed on to the consumer in some form to some extent. And so I just don't see a scenario in which this is not a consumer protection issue vis-a-vis affordability of financial products and services. Every time you use Venmo to pay somebody, PayPal, et cetera, the cost of those transactions will have to go up. Okay. And so as people think about these issues, hi, John, the BPI is in the room as well. As we think about these issues, it is important to understand what the end impact of this is.
Yeah. Okay, let me thank Randy and Jelena for a terrific conversation.